Hello, everyone, and welcome to the Meet the Visionaries podcast, brought to you by the MIT Center for Real Estate. My name is Michael Khamis. I'm a student in the Master of Science in Real Estate Development program here at MIT. On today's episode, I have the distinct pleasure of welcoming renowned real estate economist and strategist Jay Parsons. Jay currently serves as a strategy advisor at Madera Residential, a partner at Waymaker, a multifamily development platform, and an economic advisor at JPI, one of the nation's leading multifamily developers based in Dallas, Texas. Over the years, Jay's become one of the industry's most trusted voices, blending sharp economic analysis with on-the-ground investment insight. Jay also reaches a wide audience through his hit podcast, The Rent Roll, his widely read newsletter, jparsons.com, and his must-follow commentary on LinkedIn, where thousands of real estate professionals turn to for timely, data-driven market perspective. Jay, I'm really excited to have you on the podcast today. Thanks for coming on.
Yeah, thank you for having me, and thank you for the kind words.
Absolutely. And for those of you that aren't already following Jay on LinkedIn or subscribe to the Rent Roll podcast, I can't recommend it enough. Whenever major news breaks impacting real estate, Jay is typically first to the punch, and his insights aren't just opinions. They're sharp, they're data-driven, and often frame the conversation that follows with the rest of the industry.
Thank you.
That being said, Jay, a recent theme that has real estate professionals scrambling for data is how the current immigration landscape is going to impact real estate nationally. And you just shared a workforce survey conducted by the AGC and NCCR that highlighted stepped up immigration enforcement as a new stress point for contractors. In that report, pulling some data, 10% of firms had workers leave or fail to appear because of actual or rumored immigration actions, and 20% of those subcontractors reported losing workers. More broadly, 28% of contractors said their firms were directly impacted, and of the contractors that were surveyed, 45% cited worker shortages as being the number one driver for project delays. From your perspective, Jay, how might these labor pressures shape the commercial real estate market going forward in terms of costs, timelines, and project feasibility?
Yeah, that's a big topic right now, and for good reason. And it's interesting. It's I guess first of all on the construction side, it's only an issue in some spots. And so what we hear about is that if it's either a big issue or it's not an issue at all. It's probably a better way to say it. Mm-hmm. And so we hear about is if there is an enforcement action at a particular site, there's workers who are coming back, and that may also affect nearby projects as well. But then we've also heard from developers and builders who said that they've had no issues at all. And so it just seems to depend on kind of where it is. And then the thing that I think is the really important piece of this is that right now there's a kind of a macro factor that's mitigating some of this. So let me back up a little bit. 40% of their construction labor force in housing was born outside the U.S., according to data from the National Association of Home Builders. And so it is a big deal. But right now, we're completing a lot more housing than we're starting. And so because of that, you have a lot of subcontractors who are now competing for jobs when these last few years, they had a lot of jobs coming their way. And so because of that, there's we're not really feeling the impact of any potential reduction in labor force because there's less demand for that labor. And so I don't think we're really going to feel it. And so because of that, it's not really impacting construction costs yet. In fact, labor costs, what we're hearing from subcontractors, are coming down. However, if and when construction ramps back up, and obviously more when, not if, at some point it will, we don't know when that'll be, I think that's where we're going to potentially see more issues.
Another interesting statistic in the survey, 83% of the firms responded that they had open craft positions, and more than half of the candidates lacked improper qualifications. How do you think this plays out in the next 6 to 8 months? Do you think developers and lenders are accounting for this escalation in labor costs and deceleration in anticipated efficiency?
My hunch is I don't think it's going to be a short-term factor. I think there's too many headwinds to getting construction ramped up quickly related to, rates and rents in particular. And so I think that I think this will likely be an issue further down the road in a couple of years. Because as you know, the problem is that, if you have the more this kind of builds over time, there's fewer jobs out there. There's fewer immigrants coming into the market willing to work those jobs. So let's say it's 2027, a couple of years from now, and then construction ramps back up, the labor force is contracted. It's going to make it harder for those jobs to then then find qualified labor to ramp back up again. And I think it's also going to be, I think there's a number of factors, and this is one of them, that is going to make it harder and harder for smaller groups in particular to really stay active and compete. If you have the bigger groups are able to bring in, they bring a lot of their trades in house, and these are generally folks who are some of the more experienced workers, and so, but for those who are who need to rely more on subcontractors hiring out jobs, and don't have one job lined up for the next, can't keep people busy, I think it's going to a reduced labor pool is going to have a bigger impact on those smaller groups that suddenly will have a harder time accessing experienced workers.
Right. And just to backtrack a little bit, because you brought up a good point about how this is going to disproportionately impact certain markets. And I think the survey keyed in on an interesting point here. Contractors in Georgia had a 75% impact from immigration enforcement. And in markets like Idaho, only 8% of contractors reported having immigration issues. So do you think this is going to start to play in the next few years in how investors select the markets that they invest in?
Yeah, that's a good question. I don't know that it'll have an impact in that regard. I think there's a number. I think the bigger story, though, is I think we're at a transition point or an inflection point in terms of who's able to build. And so even in, take Atlanta, for instance, in Georgia, there's in most markets across the U.S., historically, for apartments, 75 to 80% of the apartment starts are coming from small local groups, and they may do one or two projects a year. But those smaller groups, they have their cost of capital is much higher, so they're more impacted by the high rate environment. They have less efficiencies of scale, so larger groups can warehouse materials, they can buy in bulk. Right. They're taking more of I hate to use the word cookie cutter, but they're basically taking the same plans and then building the same concept in multiple sites. So it makes it easier to scale and reduces your costs that way as well. And then, of course, also being able to bring more of their trades in-house and, using various technologies and make the process more efficient. And so the construction labor, to me, is just one piece of that puzzle where, I think it's going to, my personal theory is that this next cycle is going to look kind of what happened to the home builders coming out of the great financial crisis. We saw a lot of consolidation. And I think the same thing is likely to happen in the apartment side, maybe not to the same degree, where the bigger developers take up larger market share just because of having access to better and more reliable labor, or having a lot of, again, in-house. You have lower cost of capital, more ability to warehouse materials, more technology to drive efficiencies and the timeline and whatnot. So I think this is just one of really a number of issues that's going to make it harder for smaller developers to compete.
It's really interesting and makes you think, how is that going to impact the size of these buildings that are getting developed as well? Are the Hines and these larger developers going to be developing the 30 million and below types of projects?
Yeah, definitely not. Yeah, it's not efficient for the big developers. I think I'll backtrack a little bit. I think that if you're a smaller developer, I think there's always be opportunities for those boutique smaller projects. But I just think it's going to be tougher and tougher to really compete, and you have to really kind of find that needle in the haystack more. And I think that we're better off with having as many builders and developers we could have. And so they're obviously we got smart people, they're innovative, they'll figure out a way. But I think it's very unlikely we're going to see construction numbers like we just went through anytime soon for this and for a variety of other reasons. Transitioning
here, you recently posted an article the summer rent slump continues. And you noted that July rents fell 0.01% month over month. That kind of continued into August as well. And you noted that that was the weakest July since 2010. Oddly enough, at the same time, renewal rents were still growing at 3.8%, and wages have continued to outpace rents for more than 2 years. In your view, is this the bottom of the current rent cycle, or do you think this is the beginning of a more affordability-driven reset?
Yeah, no, that's a big question, and the short of it is I don't know, but I can give you a few thoughts here. I think, what's really interesting is we don't see any of the real telltale signs of a real recession specific to the rental housing market, the SF single family rentals and apartments. And I say that because typically in a real slowdown, there's a few things that would happen. We would see significantly reduced net absorption. Mm-hmm. This is just the change in number of occupied apartment units. It's, it's how we measure demand in the rental housing market. Well, those numbers are fantastic. They're some of the best numbers we've seen in the last 25 years, behind really only 2021. And we all know, that was obviously a crazy year with little supply, a lot of demand. This year we have a lot of supply, a lot of demand, but even more supply. The other thing we don't see is household consolidation. Typically in an affordability-driven slowdown, you see people deciding to double up, households consolidating together. That's not happening. In fact, we saw more household expansion these last few years, and it has not reverted back. At least not in the, there's always could be exceptions, but generally speaking, we've seen no evidence of any kind of household consolidation. And then on top of that, as you alluded to, we see very high retention rates. People are staying in place. They're renewing their leases. We could talk about this more, but I think, a lot of people want to give all the credit to the home buyer market, but, this is a trend that predates that in the rise of mortgage rates. It's been going on for a while. And then they're renewing their leases. They're typically paying, 3 or 4% more to do that, and they're still doing it. So we don't see any real signs of a slowdown. That's not to say it can't happen, but those signs just aren't there yet. And so you look at, what is happening, and you mentioned this. I mean, the rents are falling for new leases. That's the advertised rents. Everybody sees rents. We see rents in the news and headlines or whatever. Like, it's usually the new leases, and that's the leading indicator. The rents have been falling. And you mentioned it wasn't a lot this summer. It's like 0.1% in July, but I think it's maybe 0.25 for the whole summer. That doesn't sound like a lot, but that's the first time we had any negative number since the great financial crisis. And so typically this is the season of seeing rents increase, not fall. And so what's really happening is just it's supply. And it's, I think everyone wants to have got a lot of other reasons to explain it. But, I've done a lot of work on this, and the relationship is very clear. Where we're building a lot of housing, rents are falling. Where we're not building a lot of housing, rents are still increasing at a pretty normal rate.
Curious, what are your thoughts on some of these very oversupplied markets? And honestly, I'm going to hit this later on in the podcast, but where do you think that timeline-wise, some of these oversupplied markets are going to start to absorb all that supply?
Yeah. You're hitting all the big questions in the industry right now. It's another big one. I will have to I have to throw this out there because I don't like the word oversupply. And so I don't think any market is necessarily oversupplied. And I say that only because, I think that word kind of implies that there's too much housing. And I think people see that. And then at the same time, there's headlines saying we're, 4 or 5 million shortage of housing, units short, housing shortage. And so I like to call it, I think, hopefully more accurately, it's a temporary supply demand imbalance. And I think what's happening now is you have particularly these high growth markets. The demand has been steady, but supply comes in waves. And we coming out of the COVID period, we saw there was a temporary shutdown in supply. At the same time, this big demand wave. And so you had what people call undersupply. I would just say was, in that period, we already had undersupply, but now that was exacerbated by kind of the dynamics of that period. Then we overcorrected. We started building a lot more housing. Maybe, again, overcorrect is probably the wrong word. We tried to correct for that. And but the issue, it's kind of like I give the analogy to like if your town's experiencing a drought and you just open up a fire hydrant and start pouring the water out, that's going to help, but you're going to have a lot of wasted water that can't get really used in the short term until you're able to figure out how to, tap into it correctly and get it to everybody who needs it. And so I think that's what's happening in the apartment sector now. So to answer your question, sorry for that roundabout way of getting to this, but to answer your question, I do think we're going to absorb these units. I think the demand is there. I think it's going to take time for it to catch up. I think for most of the country, we're going to see that happen over the next 6-9 months. I think as long as the economy remains in decent shape, it doesn't have to be booming, but as long as we avoid the R word, the recession, we still have low unemployment and at least a little bit of job growth. I think by next summer, we'll be seeing more kind of normal occupancy rates again. Nothing crazy, but I think we'll be back to normalish numbers. And there's going to be a handful of markets. Obviously, Austin's the poster child for this. That could take a little bit longer.
Yeah.
But, they'll get there as well. It just may take, further into the year, in the early part of 2027.
You kind of hit the second piece of my question. So Austin, you think is well positioned to eventually absorb. What city do you think that currently has a supply-demand imbalance is best positioned to absorb supply?
Yeah. So a couple of thoughts there. I think all of these markets will be fine in the long term, but it's funny that one of the things we've seen in places like Austin, and I'll pick on Austin again, is there's been this wave of headlines like people aren't moving to Austin anymore. California techies moved to Austin, realized it was too hot, now they're moving back, and all of these things are just a little bit, or maybe dramatically overstated. I mean, obviously the growth pace has slowed down, but Austin's still one of the fastest growing cities in the country.
Mm-hmm.
Everything's just moderated to more normal levels after a period of unsustainable growth. So Austin will be fine, but I also think you think about like the bigger among like let's say top 50 MSAs, Austin, Nashville, Charlotte, these have been some of the fastest growing markets in the country in terms of housing supply as well as demand. And I think it's interesting because there's so much, I think, rightful focus both among investors, also like media is like, Austin's so hot. It's got, all the things in Austin to keep Austin a weird thing. It's got the major university, the state capital, the tech hub, all that kind of stuff. It's interesting. Nashville, it's got the music scene. It's got, the Bachelorette Paradise. It's got all the things. And of course, another, a lot of, medical jobs and another major university, all the like. And then, it's interesting because like, Nashville has on TV show. I don't know if they canceled that show yet. It's on TV show for a while too. And Charlotte is, I kind of call like the forgotten of the triplets, and it doesn't get the same sort of buzz. The jobs there aren't quite as sexy. It's a little more like, business services jobs, but it's also, incredibly diversified economy that, I think they have something like 8 Fortune 500 company headquarters there. And they're, I think, in 7 different industries from like, energy to banking to retail, like Lowe's, home improvement. We got a bunch of different stuff there. And they continue to attract a lot of jobs that are well paying. And so that market has got a ton of supply, but it's actually held up better. And I'm bullish on, Charlotte through the next cycle as well.
We've kind of seen a lot of the post-pandemic hotspots like Texas, we've kind of alluded to already, Florida, start to cool as the supply starts to catch up to demand. Looking ahead, besides Charlotte, what other regions or metro types do you kind of see as the next growth magnet? Are we secondary coastal markets, college towns?
So, so I put this called bucket. So let's, rewind a little bit. COVID, it put a spotlight on the Sun Belt, but, I think a lot of what COVID did, like COVID got a lot of credit for things that were already happening prior to COVID. And I think COVID really just accelerated pre-existing trends, and obviously the Texas and Florida story, and I mean, they were the growth leaders in prior to COVID, and then it went into like, hyperspeed mode. Also though, what we saw through COVID was some of these smaller towns that all of a sudden we heard about the Zoom towns. And so I think what we've seen a pullback is if you're a one-trick pony town where it's like you got a great beach, but you're really like a spring break, summer vacation market, but you don't really have the amenities, and it's not it doesn't have the the services and lifestyle things that you need to live there year round. Like those places have seen some natural contraction. So to answer your question in terms of what's next, though, like I still think what's driving the major Sunbelt markets, I think will remain in place. I'm still very bullish on the larger markets across Texas, Carolinas, Florida, Tennessee, Utah, Arizona, et cetera. The mountains and Sunbelt. But I also think there's some really interesting trends among smaller markets that were, again, they were growing prior to COVID. They just maybe a little more below the radar. The COVID put more of a spotlight on them. And I also think when you're able to work from anywhere, or not every job is able to do this, obviously in some contraction in this, but that also makes some of these smaller towns more interesting as well, where it's a smaller pace of living, but you still have the basic amenities, the grocery stores, the restaurants, the movie theaters. I don't know if anybody goes to movie theaters anymore. That's probably a bad one, but all the things that you really want to do. And so we've seen places that have done well, places I'd still be bullish on, or places like Boise, some of the South Carolina markets, Charleston, Greenville, some of the secondary Florida markets are interesting. Huntsville, Alabama continues to grow. I mean, just a crazy strong economy there based on all the aerospace stuff and engineering. And then elsewhere, I think, you mentioned college towns. I think those are always going to be steady, and they've not seen as much supply in the last cycle. And then these Midwest markets, I think it's a similar story, but what we think we're really seeing there is, again, somebody started pre-COVID, it's been accelerating, is just after a couple of decades of some real challenges, like the Midwest having kind of a decent comeback story. It's not like this rapid growth, but it's steady. It's right. And we're in this period of the cycle where the tortoise wins the race. And so, places, across Ohio, Indianapolis, Kansas City, Des Moines been a growth market. I'm probably leaving a bunch out. Columbus has been really attractive. We're seeing some really positive trends in all these spots as well.
Do you kind of see any sort of rebound in some of these larger coastal gateways like New York, Boston, LA? Obviously, people are always going to want to live and work in these cities, but with back to office, that kind of changes the trends over the past few years. Absolutely. And so I'll give you my take on this. So I think it's a little more nuanced than a lot of my people in my own industry give it credit for. So, let's go back a little bit. I keep going back to COVID, but our world changed since then, and I think there's some of the after effects we're still feeling. Right. So when COVID hit, these big cities shut down, obviously, and back then there was all this conversation among the guys in Wall Street and everybody, and the headlines, everything else. Everybody was saying, hey, people aren't coming back till the jobs come back. But what happened was it turned out it wasn't about the jobs. It was about these cities reopening. New York City is a great example of this. Once the city, reopened, the restaurants, the parks. I mean, my brothers lived in New York. He had to go running with a mask on outside. And, in hindsight, that's crazy. Yeah. That was that's how different, that's how challenging it got to live there. And so once that stuff changed, the city came back. People started moving back prior to the jobs. So they just want to be in the city. It's a great place to live, right? And so, and they may have been working in their apartment. They may have been going to the office a couple of days a week, but they wanted to. There's a group that wants to be in there, and I think particularly the group that we started to see is New York City and its peer markets have always had this inbound train of young adults who want to live in the big city for a stage of life. That train shut down for a few years. Or a couple of years, but then it really came back. And I think that's been a good story. We're finally starting to see, obviously, Boston. Boston, I think, has done a good job. Chicago has come back. I think the West Coast has been much slower than the East Coast. Obviously, San Francisco probably took on the chin more than any of them in the real estate space for a long list of reasons. But it's finally started to come back. We're starting to see. We're hearing a lot more about the improvement of the quality of life issues there, and that's bringing more people back into the city. That's now the top performing market in terms of rent growth in the U.S. There's some good signs in Seattle, although some parts still have some challenges. And I think the one that's really, we could spend a whole podcast on this. The one that's really become much more of a enigma is Los Angeles, and there's some, I think, unique issues there. And primarily from a policy standpoint that have made that much less attractive, particularly for apartment development and investment. But other than that, though, I think that we're seeing a good rebound story. It's just that there's been a big shift, though, because
COVID brought in a wave of operational regulations that these places are always hard to build in, but now they're hard to operate in as well. And I think that's going to have it's already having some real implications in terms of where capital is, how much capital wants to be in those spots.
Agreed. And related to this discussion, we're seeing a lot of different approaches to housing policy. In Massachusetts, we've got recently implemented rent control caps. In New York, we've got the new 485X program that ties tax incentives to affordability mandates and higher construction wage floors. What do these kinds of policies tell us about the broader political climate around housing? And how do you see this shifting policy environment shaping the future economics of rental housing?
Well, just back up a little bit, just to make sure I get it wrong. Massachusetts is just a proposed ballot measure.
You're right. My mistake.
Yeah,
They're exploring it.
Sure I missed something.
Yeah, you didn't.
Yeah, no, it's interesting. I think that, it's really hard to talk about this topic because it gets so emotionally charged. And I think it's just so important that, hey, look, I mean, let's just take a step back. If we could agree that there are real challenges in terms of access to quality, affordable housing, I think the most compassionate and sensible thing to do is to say, okay, what does the data tell us? What does the science tell us?
Right.
And there's a lot of, academic, non-affiliated, non-industry affiliated, bipartisan research that shows that, number one, we need a lot more supply. Supply is the solution. I think people recognize that. But I think also too, we see a lot of, I think, well-intended efforts, New York, what you mentioned, New York's a good example of this, to address affordability, but we're doing it in ways that aren't backed by the research. And so what's happening in, New York is that, they didn't like the previous program, which was, I think it was 421A or something like that. And there was already a program in place, but it wasn't affordable enough. And all of a sudden, it starts to pile on. Well, the issue is that, okay, the more deeply affordable we want it to be, the more subsidies you need for that to actually work, or there's going to be lesser housing built. Right. But unfortunately, the mindset is often, okay, these developers are too greedy. We're going to dictate the terms. And New York's a great example of a city that thinks, hey, our city is so great, and it's a great city, that developers just want to be here no matter what. But developers are going to go where investors that place capital with them are willing to invest. And so you have to recognize, if you're a city or a state, you're competing for development dollars. It's not just going to go just because you exist. It's going to go where it's wanted.
Right.
And if it does not treat well in housing anywhere, it's going to go into something like industrial warehouses and distribution centers, things like that. So the natural consequence is going to be less supply in some of these areas where we just don't, inclusionary zoning and issues like that are just, ultimately been proven to be hostile to the, or end up reducing number of overall units to get built. And there's, a lot of great, I don't have time to go into, I'm sure, all these stuff, but there's so much great research now about the impact of filtering. You build more even luxury housing, the impact it has down market. So again, this is, it's not Jay Parsons saying that. This is, a lot of academic research that's been saying these things. And also, one other comment I'll make here too is, on the positive side, we've seen this really encouraging YIMBY movement, the Yes in My Backyard, and they recognize, hey, we need to build more housing. Inclusionary zoning is not helpful. Rent control is counterproductive to its cause, but we need to make it easier to build, and zoning, permitting reform, all those things, and that's been fantastic. We're seeing some wins in places like California, but also in like conservative places like Arkansas and Florida, and so that's been great. But I think one thing that's kind of the next hurdle to have to overcome is recognizing that, particularly in a place like California, New York, is it's great that now we want to celebrate development and say yes, we want to build more, but you have to remember, specifically for rental housing, if you want to celebrate development, but then you're still going to demonize the operator,
right?
You can't build something if you can't operate a business plan, and so we need to still create a more. It doesn't mean giving the developer and the operator everything they want, but it means creating a more collaborative environment in some of these cities. And I think that's what's missing in some of these big markets today.
Agreed. And developers are being forced at this point to build, like you said, build less housing because of some of these mandates. Like in New York, there have been number of articles written about the number of 99 unit permit applications that have been submitted because 485X ties to 100 units. The deals aren't penciling at 100 units and above, and it's unfortunate because it's just going to perpetuate the cycle of developing units that aren't going to quench demand, especially in a supply constrained market like New York. Hopefully, public and private interests can meet at the table and try to figure out a realistic strategy to tackle this affordability crisis and bridge this gap.
It's well said. And I'll make one other comment, which is that I wish more of our policymakers and housing advocates would understand, like, across the industry, like, and I know that some people just won't believe this when I say it, but like there are a lot of people who really want to be part of the solution, and a lot of groups that do, but they feel like they're being demonized and like they're not wanted in certain cities, and particularly if you're from an area, like you want to be part of the solution, you want to build housing, you believe in that, but you no matter what you do, you're treated like the bad guy. And I wish more people understood. It's like people, obviously there's examples of bad landlords. I'm not going to downplay that, but pretend like it's not true. But the vast majority of them want to be part of the solution. So we need to get back to this. I bring this analogy. I hope that we can learn what the environmental movement did, which we had brought like the green businesses together with the pro-environmental groups, and they came together and found some real solutions. We need that to happen in housing, which is the industry and housing advocates, policymakers, just come together and say, hey, look, let's unite around these things that we actually do agree on, like getting more housing built.
Right. It's finally happened. We got a rate cut, 25 basis points. I know that's been long awaited. In Chairman Powell's remarks, he acknowledged that while rate cuts can help housing, they can't solve what he quoted as a pretty much nationwide housing shortage. And I thought that was interesting that he kind of acknowledged that. You've emphasized that the big needle mover for multifamily and built to rent isn't REITs, but rather rents. Given that framing, how should developers and investors think about the limits of monetary policy versus the structural supply problem? And what needs to happen on the rent side before we see a real rebound in construction starts?
Yeah, no, that's a great question. So, it's for developers, as they need deals to pencil out, and so it's either you have to have lower costs, and a lot of the cost today is really not so much the materials, despite all the stuff we're talking about around tariffs. It's really related to the cost of debt, or you'd have higher rents. And I think that the challenge for a lot of developers right now is that, the quarter BIP is helpful, but it was, first of all, it's pretty much already priced into the market. When interest rates went up, 400 bips, cap rates only went up 100.
Right.
And so it's pretty much already priced in. And then there's really, no one is really expecting a scenario where we get, 100, 200 basis points of cuts, which would really move the needle. And so hopefully we get more, but, to get back to a true low rate environment. And there's always people who say, hey, look, today still is low compared to the 70s, whatever. But today's developers weren't around in the 70s for the most part. So that's not a relevant point. And then so that gets you back to your point on the rents. This is something I think, again, a lot of the public sort of misunderstands, is that what you really want, really what the Fed's trying to target. They talk about, this, getting back to a, sustainable level of inflation around that 2% target. Like, you do need a little bit of growth. And developers and investors, like, they don't need 10% growth. Like, you don't need 10% rent growth to justify a business plan, right, or a development. But you do need to have some growth. And the challenge right now is, if you're a developer, you need to be able to tell your investors and lenders, like, this is going to be the target rent that we can achieve, and here's how we know we can get to that level. If you can't, in today's market, where there's so many concessions and rents are falling, it makes it really hard to say this is what the rents are when we deliver this property. And so what we really need to see is rents stabilize and get a little bit of growth, so then developers, and more importantly, the capital that backs them, and say, yeah, that's a safe number that we can build to, and not have a lot of downside risk. So we really, if we get back to just some moderate growth in the 2, 3, 4% range, that's going to be, I think, a good signal for development.
And on monetary policy, as Chairman Powell said, the Fed can't solve that shortage. What do you see as the most impactful policy levers? Is it local zoning, immigration labor policy, or like federal incentives?
Yeah, so that's a good question. I'm a little more old school on this. I think incentives would move the needle quite a bit. I think that if we need something, if we want more of something as a society, we should incentivize it. And this goes back to the comment I made about the kind of the pro-environmental policies earlier, and the we incentivized it, and we got some results from it. And the on the housing construction, I think it's the same thing, that we need to build better incentives. So programs like opportunity zones have been tremendously helpful. That program has led to more than 300,000 new housing units being built that the vast majority of them would not have been built. There's been some cynical coverage of this, but I've seen a lot of these projects. In some of these areas, they would not have had any housing built if not for that program. It's in things like the low-income housing tax credit, expanding that. But to really kind of pin to your question more, I think we can find new ways to incentivize housing. I think when you incentivize it too, you can build in, income requirements as well for the renters, low and middle income programs, because that way you're subsidizing the benefit that you're giving to the renter. But also too, I think a big thing we could do that I'm hopeful that we can see in some type of policy reform or executive order or whatnot would be some more rules around the use of federal tax dollars to build affordable housing. So the low-income housing tax credit, for instance. Well, one of the problems today is the current program allows cities to basically dictate how federal dollars are spent. And so because of that, you have issues like, there's a famous example, I keep picking on Los Angeles, but in Los Angeles, there's a LA Times article about this a year or two ago. It costs $1 million per unit of affordable housing. And that's far more than it costs to build, quote, luxury housing.
Right.
And the reason is because they add all this kind of pork barrel spending requirements on top of what if you want to access those tax dollars, that are federal dollars, by the way, you have to do all these other things. You have to use, these type of labor groups. You have to use these type of materials. You're going to pay these carbon offsets, like all of these things. And they're all like, it's not that any of those things are bad, but you add them all up, and all of a sudden, like, your project costs are out of control. And that's not an efficient use. And so the end result is we're able to build fewer units. Mm-hmm. And so we need to put more. I think one thing the federal government can really do as a kind of common sense bipartisan solution is say, hey, if you want to access these dollars, we want everybody to, by the way, every state, whether you're red or blue, these are the rules we need you to play by in order to, and the goal being, not some, sort of political outcome, but really very simple. Like, we want to build the maximum number of affordable housing units.
Right.
And I think that would result in a very significant increase in affordable housing supply.
Yeah, it's really well put. I had a question about your recent article. It was the Q2 25 REIT earnings highlights, and you pointed out that expense growth had come below expectations. And as we spoke about earlier, the strong renewal rent growth, even as new lease rent lags. Given all that, what signals from the public operators do you think are the most important for private owners and investors to heed right now in terms of cost control, lease pricing discipline, and where to direct development or value-add capital?
Yeah, that's another good question. So, it's in the apartment world, the REITs are a small part of the market, but obviously have outsized influence by nature of being public. I think they have had a lot of influence on the operations side and the use of technology around things like, online leasing and centralization, automation. I mean, things that make the leasing process a lot faster and smoother for renters. And, the goal, of course, for an operator is you're able to, increase your likelihood of turning a lead into an actual lease. And so in terms of signals, I think that, there are a couple of things. Number one is they've signaled that, some of them at least, Avalon Bay, MAA being the best examples of this, Camden as well, that they want to build again.
Right.
And I think that's an important signal because, the one hand, they're not representing everybody. They have a lower cost of capital. They have they're a build to hold, not a build to sell, which is not like most developers. But the fact that they're willing to build again, make that long-term bet, I think is an important signal. Mm-hmm. And the other thing I think is going to be an important signal as well is the REITs, like most of the private industry, has been really focused on prioritizing protecting occupancy. And because, again, despite the social media conspiracies that tell me this all the time, is there's zero revenue associated with a vacant unit. I don't know why anybody believes otherwise, because the math doesn't really work. You can't make money off a vacant unit, but they need to have occupied units. And but there's been so much nervousness about losing occupancy, therefore revenue, if they start pushing rents again. And so at some point, though, they've been signaling is, hey, we're looking to be able to get more rent growth again on the new lease side, because new lease rents have been falling, as we talked about earlier. And so I think if, over these next couple of quarters, I think that's an important signal as well, is when are they willing to start, again, no one's expecting it to be like 21, 22 again, but when are they willing to start, pushing a little more on the new lease rent side to get kind of back to normal sustainable growth?
Jay, thank you for your perspective. We've kind of ran through a lot. Thank you for joining us this afternoon and for sharing your insights with us. It's been a lot of fun. And as Denise mentioned before we started recording, please reach out to the center if you're in the Cambridge area. We'd love to host you for a day if you're in the area.
I'd be honored. Thanks for having me.
Of course. And to our listeners, thank you for tuning into the episode of Meet the Visionaries podcast. And be sure to tune into some of our upcoming episodes as we have some very exciting guests slated for this fall. I'm Michael Khamis, and I'll see you next time at the MIT Center for Real Estate.
Thanks to our listeners for tuning into another edition of Meet the Visionaries podcast. And please remember to stay tuned for future episodes by subscribing to our podcast or follow us on social media by visiting cre.mit.edu to learn more. Until next time, take care, listeners.